Hey, Bowtie Nation. Joseph Hogue here with Marcos Mia at the SIBO Global Markets here in Chicago. Great opportunity to get the ETF guy here on the channel, get his thoughts on some of these high income ETFs. Marcos, thanks for being here with us.
I'm super happy to be here and super happy to be on the channel and love the work that you're doing as well.
Great. Then let's get into it. Go ahead and introduce yourself, and then we're going to get into some of those high yield dividend or high yield income ETFs that I know a lot of investors are really loving right now.
Yeah, thank you so much. So my name is Marcos Mia. I have a YouTube channel. I basically cover everything ETFs from dividend, growth, broad market, S&P 500, cover call ETFs, and pretty much everything in between, from interviewing ETF portfolio managers and CEOs to just covering ETFs that I think that retail wants to know more about.
Excellent. Great. Well, let's get right into it. I know a lot of investors are loving the high income ETFs right now, especially one of the ones I've been watching, the QDTE, and some of the newer ones, the ULTY and the MSTY. Take us through each one. How are they creating that income? What are some of the strategies behind each, and what do investors need to know about each?
Yeah, so I think the craze this year, and even just like in the past few years, is just cover call income and kind of going for a higher yield. We got JEPI, JEPQ kind of have the inception of like making cover call ETFs popular with about 7 to 10% yield. Now we're seeing, Yieldmax ETFs coming out with yields of about 70, 80, 90, 100%, which is wild. So, these investors just want these high income products that basically they either hold the underlying or they use synthetics to basically like replicate the stock price, or just own the underlyings like actually, and then they'll basically sell cover calls or sell options against it to generate income for investors, and then they pay it out either weekly or monthly depending on like the frequency. Some of them are doing it twice a week now, and then some of them I hear on the street might be doing it daily one day, but I'd imagine that in the next year we might see some daily income ETF products. But it's been a crazy year this year, and so many issuers are coming out with these high income products, and investors really love these products because it fits their needs of income now rather than growth, and they just love holding these products, and it keeps them motivated to invest.
Excellent. I know we've covered the QDTE here on the channel before. I'll link to that video in the description. Great weekly income ETF. Can you compare and kind of contrast the styles for the MSTY and the ULTY? I know they're both extremely high income. One is actually a weekly payer. So how are they making that? What kind of stocks are they investing in, or derivatives? And what do investors need to know when they're comparing two very, very popular income ETFs?
Yeah, so with MSTY, you're basically investing, or even just like you're basically investing in MSTR, which is strategy stocks. So you're investing in a single stock, and then Yieldmax will go in there and sell call options against it to generate income, and it pays a super high yield. I think the yield is like 80% right now, but that's only one single stock. So you have like concentration risk, and it's going to be more volatile and whatnot than investing in like an index-based cover call ETF product like a JEPI, JEPQ, SPY-I, Triple QI by NEOS, for example. And then you got ULTY, which is their like flagship ETF, where you want ultra high income, and that's kind of the ETF for investors. And they basically hold a basket of securities. I think it's about like 15 to 25 securities about. And then what they do is they hold highly volatile securities with high IV. And then with high IV comes like more option premium. They pay it weekly, and you're going to see some more like riskier plays from that ETF. And it's basically for investors who want hopefully a stable distribution every single week, which it's kind of been doing that, but it's for investors who want income. These products are all for income. Depends on like what you want out of the ETF. So I would say ULTY is more for diversification. MSTY is for like that single stock exposure to strategy and Bitcoin if you like that exposure. And then you can just buy it and hopefully see some good income from it, and hopefully a good total return, because with these super high income products, you're going to see what's called NAV erosion. So when you're paying out super high income, it's going to come from somewhere. It's going to come from your NAV. But when people have to factor it back in, is they have to factor back in the income. I think we talked about it on the way here is, you might see like negative returns, but when you look at the total return, you could look at it on stockanalysis.com. It's positive for most of these products.
Okay, so you've got the QDTE, which is kind of a 0 day to expiration weekly income fund. That's how they're creating that income. You've got the MSTY, which is I almost said MicroStrategy, but I guess it's strategy now. The MSTR, it's using swaps, which are just contracts with a bank to get pretty much the same return as you would holding the stock, and then they use contracts against that. So it's a very, very concentrated fund that they're using. If you think of MSTR as a leveraged return on Bitcoin, okay, so if Bitcoin goes up, MSTR strategy usually goes up even more. This fund is a leverage on top of leverage, so that's how they're really creating that income. And then ULTY is a little bit more classic, holding those different stocks, those high volatility stocks. And what the portfolio manager does, he just keeps track of all the stocks in the market that have the highest volatility, right? And why that's important, of course, is because he's selling call options against those. And with more volatility, the premiums that he collects by selling those call options goes up. So he's going where he can get the most money right now. Not necessarily the most money over time, but the most money he can get right now by selling those call options and deliver that income to investors. So an important part, I think, is a lot of investors, look at these, and some investors maybe want that income. Some of them want a total return perspective. Is there any idea or any perspective on which ones are better for those different types of investors? So which ones of these, the QDTE, the MSTY, the ULTY, which ones might be better for income, and which ones might be better for the total return investor?
I would say for ULTY, for example, by Yieldmax, that will be way better for income. It's kind of like the exact goal for ETF investors. MSTY will probably be the best for, I'd say, more of a hybrid, maybe even leaning more towards a total return, just because, like I said before, a leveraged play on Bitcoin for a strategy. And so it's going to be a highly volatile, and we've seen the returns for MSTY since inception. It's been pretty incredible. And then the QDTE will be, I'd say, a good mix of both income and maybe a little bit of total returns as well. But some investors do know about like other products. So there's a Roundhill, which basically uses leverage to kind of juice up the returns a little bit with income. And then some other products that are coming out now with, I know Neos has some new products that might come out with some sort of leverage as the underlying. So some of these issuers, they're basically solving the problem of NAV erosion with a leverage, which will make the charts look a lot prettier, but it's going to be a little bit more risky on the downside.
And I love the air quotes around solved their NAV erosion, because that's kind of what it is. Kind of, they can use leverage when times are good and when the market is going up, and kind of solve or help minimize that NAV, which when we say NAV erosion, that's the net asset value. It's basically all the market cap of the stock, right? So the stock price in effect. And what happens is that NAV, that stock price, goes down because they're paying out so much of their capital as dividends, as those distributions. And in fact, we'll get into how part of your return is actually a return of your capital, a return of the money you invested, rather than a return on. So rather a traditional investment return. But how have some of the distributions held up on these? How have they fluctuated quite a bit, or has one fund been able to hold theirs a little bit more stable?
Yeah, I would say for ULTY, for example, that one's been a lot more stable than other products, because it's kind of, they do different, I guess, strategies to keep the net asset value stable. They have like protective puts. They'll have some like put options for like protection. They go long as well. So that one's gonna be like more like stable distributions a little bit. It all depends on the market, right? And the underlying as well. MSTY has been kind of one that's been like seeing lower distributions as well. But I would say that like it just depends on what yields and like what option shop like you're kind of investing in. So for example, like Neos, even like JP Morgan, Goldman Sachs, those ETF issuers have more like stable distributions, even Tap Alpha as well. And then some other shops might have like the highest income possible, but you're not going to even expect like the stable distributions. It will be volatile, so it's kind of like the game you play with these income products, and everybody has their own twist and what they like and what they don't like. But I personally like the ones that have stable distributions, and people could actually like rely on them more than the ones that are super volatile.
Okay, excellent. And to find the history of distributions, a lot of times, well, I mean, you can go to the fund's website. Okay, so just Google in the name of the fund; it'll take you directly to its website. Or on Yahoo Finance, you go in the historical data tab and look for dividends. Within that, it'll tell you show you all the dividends over the past 5 years or even longer, to get an idea of how much those dividends have gone up and down, and they will go up and down. Just the strategy used by these funds, selling those call options every month, the premiums on those call options are going to go up and down, as well as just the volatility in the market is going to cause those to go up and down. So don't be alarmed when you do see the distributions or the dividends go up and down on these. It is really that total return that you're getting, as well as whether that income actually meets your needs. That's what's important there. So I think that's a great segue into really the risks in these, because I think investors get dollar signs in their eyes and they rush after the 80, 90, 120% income yield reported on these, and they forget, or they don't even look for the risks on theirs. So what are the specific risks in each of these funds?
I would say that some investors might think that the downside is limited, but you do carry pretty much all the downside on these cover call products. You have limited upside, so you're pretty much capped. So if I invest in a cover call ETF that invest in MicroStrategy or strategy like MSTY, that's going to have less total returns versus just holding the stock straight up without cover calls on it. So that's kind of another downside as well. I would say you have a risk as well in terms of going in concentration into like a single stock cover call product versus one that's diversified. So it kind of depends on like your own flavor of risk as well. And like I guess the main risk, in my opinion, is just people just not understanding what they're owning. So they look at the yield and they just buy it, or they look at the distribution frequency and they buy it, and then they complain when the underlying goes down, NAV erosion, the total return is bad. They blame it on the issuer and they say it's their fault. But like for example, like MSTY, amazing return since inception, and then this last year it kind of lost steam, and people are complaining like, oh, Yieldmax is horrible because they're not fixing Misty. But if you know how it works, they're doing exactly what they're doing, highest income possible. And unfortunately, if the underlying goes down, your fund will also go down. But if you also have the underlying going down, you're going to see they're still going to pay distributions. You're going to have a NAV erosion on top of NAV erosion. It's so many things that could go wrong, but hopefully people can understand what they're buying.
Sure. And when we talk about underlying, we mean, what is the fund actually buying? What's that underlying stock or the strategy they're using? So for MSTY, they're buying, they're in effect replicating a position on strategy, on MSTR, right? So they're using swaps, but in effect they're getting the stock and then selling call options against that. So of course, if the stock doesn't do well, then that ETF isn't going to do well either. And of course, MSTR is all Bitcoin right now. It is actually money losing on its main business. So Bitcoin is really all it has. If Bitcoin goes down, MSTR is going to go down, and MSTY is going to go down as well. So just understand the strategy behind these and where it's going to go, and really have that outlook on the underlying or the stock as well. So if you have a bullish, an upside outlook on Bitcoin, then you get leverage on that by buying MSTR, and you get double leverage on that by buying the MSTY. But you do have to be able to ride out the roller coaster that is Bitcoin on that, as well as ULTY. ULTY, it does hold a bigger portfolio of stocks and then sells those call options against those. But I think calling it diversified is a little bit of a misnomer, because all of these stocks, one, they're the highest volatility stocks out there. So they're the stocks that bounce up and down 5-10% in a day typically. So what you're going to have is, if the market does sell off, all of those stocks, no matter what business they're in, they're going to come down as well. But also they are very tech heavy. They are very crypto heavy. And so I think a lot of them are quite a bit more correlated or related than what I think investors might think. So again, just understand what is in these funds, how the market returns and how those stocks are going to affect your income in those ETFs. And again, be okay with that. If you're going to invest in these funds, you have to know what they're doing. You have to be okay with that strategy, and takes the ups and downs, because there will be some downs, but there's going to be some really good ups as well. Now, for investors in taxable accounts, because I know the taxes on these can be very wonky, what would you suggest people do with taxable accounts, non-taxable accounts, and how are some of the taxes handled in these ETFs?
I mean, the main way to kind of get the best tax benefits is always go with a Roth IRA. Unfortunately, there's also like limits to it. So it's $7,000 per year if you're under 50 years old. Then if you're over 50, that becomes $8,000. So some people might think of it as like not a lot of money, but the taxes do add up over time. There's different ways of characterizing like return of capital. So from my understanding, it's kind of like a tax classification because if it's all income and it's all dividends, then you're going to get taxed like off the charts. But basically, some of these are meant to be like pretty tax efficient. There's different ways that these ETF issuers kind of go about making it more tax efficient. But from interviewing other individuals who have like $1 million and only cover call products, or maybe even like 2 million on my channel, most of them don't even have like that big of a tax bill because of its classification as a return of capital. There are different ways to make it not as bad as you think versus what people would expect with return of capital. Yes, some issuers do return your capital just because there's like constructive return of capital and then destructive return of capital. In my opinion, you should go for the ones that have like constructive return of capital, and those are to be the ones that have like lower yields, unfortunately. But return of capital, people think it's a demon, it's like a nightmare, but it's just the way it goes with these income products being classified for an IRS standpoint. Like they have to classify it as ROC, or that's just the guidelines that the IRS has for ETF investors with covered call products.
Excellent. Okay, so very important to understand the difference between that return of capital, return on capital. One's an investment return, one is really a return of your money. So they are taxed differently. And to understand that, if someone was looking to add just one ETF, then one high income ETF, what would you say to them? And if it's one. If it's different for different types of investors, which ones would they go with? Who would go with the QDTE? Who would go with the MSTY? And who would go with the ULTY?
I feel like with ULTY, it's for an investor who wants high income, I guess a little bit more diversification than going in on MSTY, because I believe strategy is one of the underlying holdings in ULTY. So if you want high income, maybe like a bear to entry, because the stock price is like $5 right now. So people like getting as many shares as they can. So if you want high income, diversification, and your sole focus is income right now, then ULTY could be one for you. Obviously, do your own research, and I'm not a financial advisor. MSTY would be one if you are one who likes Bitcoin. That's like the main thing. If you like Bitcoin, if you like single stocks, you're willing to take on that risk, and you want income off of strategy, then I say that MSTY could be one for you as well, because you have to be bullish on the underlying. That's the one thing that Yieldmax always says, even other issuers, is you should own a cover call ETF that you are bullish on the underlying. Because if you are bullish on it, then you just shouldn't own it. Because if the underlying stock goes up, then the total return of the cover call ETF will be the best. I know people say like, oh, like Marcos, why would you say that it's the best? But because it'll perform better than like flat markets. But bullish on the underlying on Bitcoin is for MSTY. And then if you're QDTE, if you want more of an index-based approach, diversification, income as well, maybe not like the best total returns. Oh, I say, hold up. Diversification, income, and some solid total returns, then QDTE might be one for you.
Okay, excellent. So great talking to Marcos here. If people wanted to find you on YouTube, and really, what's a video you would recommend on this topic, on the MSTY, the ULTY kind of trade-off?
Yeah, I have a perfect video for you. So you can go to my channel, Marcos Mia, and I have interviews where I've interviewed ETF CEOs from Yieldmax to Tap Alpha, Neos, Vista Shares, pretty much everything you could think of. So I have like one of the most viewed videos about ULTY and MSTY by Yieldmax. I think it's had like 120,000 views, and it's a 1 hour in depth, like no BS of like what is ULTY, what is MSTY, everything you can think of, from ROC, from performance to risks to like what's the truth about it, all with Yieldmax's portfolio managers. So that's a good one on my channel.
Excellent. So I'll link to those in the video description below, the MSTY ETF, the ULTY ETF. If you're interested in those, if you're attracted to those dividends, please watch those videos first, because there are a lot of risks and nuances within these that you need to know. Marcos, thank you for coming on the channel.
Appreciate it.